Good afternoon, guys, and welcome to the Q4 webinar. And I'm happy to welcome back Lon Welsh. He's from Arrington Capital. He's been doing these webinars over the last 3 quarters, and December 2025, he's going to update us about the national trends update. It'll be a fascinating discussion, a lot of change and a lot of progress, and looking forward into 2026. So Lon, welcome.
Thank you so much for having me. It's great to be back.
Yeah. And briefly introduce yourself and we will dive into the questions.
Yeah, I worked in corporate finance for a couple of years, went back to business school. I worked as a strategy consultant for 8 years, Deloitte and then Accenture. And then I spent the last couple decades in commercial real estate. I built a real estate brokerage from scratch called York Castle, became the biggest independent brokerage, about 750 agents. I sold that using all the things I've used for the last couple decades. And it's off to a great start. We help investors invest passively and diversify.
Yeah, excellent. And so we'll dive into the slides here. Let me just tell me to advance the slides and I'll let you take over.
Yeah, why don't you go ahead one more. And for all of you guys who want the slides, we're very happy to share all these with you. I'm going to go through them pretty rapidly, just getting a couple of very high points. But if you'd like to explore in more detail, of course, you're very welcome to get the entire pack. At the end of the slide pack, we've got a URL you can go to where you can download a free copy of our book on passive investing, if that'd be useful to you. Let's go ahead and hit the next one. So I'm going to hit just like about half of these topics today because we only have about a half an hour. I want to start off with consumer confidence, because that's the biggest driver of our market at the moment. So next slide, if you take a look at the University of Michigan does a study every month of consumer confidence, and they ask quite a few questions about how optimistic do you feel about the economy and your job and things like that. And you can see that all of the negative headlines we've had over the last 6 or 8 months have really declined to a lot of negative consumer confidence. As a result, people are more reluctant to buy a car or a house or any other really large commitment of a purchase. Let's go next slide. There we go. Oop, I skipped one ahead. So we'll go back. There we go. So one of the questions they ask, is this a good time to buy or sell a house? And you can see the stats right now aren't so favorable. So for those of you who have investment rentals and you're thinking about selling them, I wouldn't pick this as my time to sell. It maybe in 3 months or 6 months, I think things are going to be quite a lot better. But right at the moment, it's an adverse time to be a seller. If on the other hand, you're interested in becoming an active landlord and picking up more properties, this is the time to strike, because a lot of sellers are feeling some desperation and they would be more receptive to an aggressive offer than they normally would be. So for you, it's a very good time. The next slide. So inflation is a little bit above the Fed Reserve target, but since the job market has been soft recently, we're anticipating we're probably going to have a rate cut in December and probably 1 or 2 more next year. And that should be a stimulative economy effect, as well as helping out the real estate market. Go ahead one. And here's unemployment. You can see that it's ticking up very gently. The recent stats that came out in the Wall Street Journal yesterday show that the most recent payroll figures are a little bit soft. And I think that's definitely gives some drive to the Federal Reserve to cut the rate. But unfortunately, it's also leading to fear among some Americans that they are worried there's going to be a recession, or if they lose a job, they may not be able to find one. And that makes them very reluctant to spend. Next. So job growth is slowing down. We just talked about that. Next slide. Stole my own headline there. And the job layoffs have been increasing. So I think the hailstorm of announcements of job layoffs that we had 4 to 6 weeks ago, about all the big tech companies all said Amazon's going to lay off 2,000 people. And that, I think we're through the majority of those headlines now, fortunately. So hopefully some of that negative sentiment is going to start to evaporate off a little bit, as it was a lot of announcements in a short period of time there. Next. This is a poll of just the rank and file of America, asking, do you think we're going to have a recession next year? And 2/3 of Americans do think we're going to have a recession. On the other hand, if you take a look at the next slide, you're going to find that most economists do not think we're going to have a recession. The vast majority think we're going to see growth in the economy next year. Nothing to have a party about, 1.5%, but it's a positive number and we'll certainly take that. So if you're thinking about a large purchase, like maybe it's a car, you're going to find that the auto dealers are having a lot less traffic in the showrooms than they're used to. They're having to compete harder to get a buyer in the door. So you should be able to negotiate harder to get a deal on a large purchase now than you would have, say, 12 or 18 months ago. So for some of you, this should be a very good opportunity. So one of the challenges that we see in the real estate market for us to sell homes is that first-time buyers are much less active than they historically should be. Student loan repayments and all the other forms of consumer debt are channeling a lot of their cash. Rents have gone up a lot over the last 5 or 6 years, and their ability to save has been diminished as a result. And a lot of renters are struggling to pay their bills. So for those of you who are investors on the multifamily side, this all speaks good news to you, because the people who should be going out to buy a house and not renting from us are going to be renting from us in some cases for a very long time. And we'll talk a little bit more about that as we progress. So I'll show you just quickly a few things on the national real estate trends. This will be residential. A lot of people are staying in their homes a lot longer than they used to. This is the number of home sales per 1,000 sales in the first 9 months of each of these different years. And you can see that we're at a very low number of home sales. Many of them either don't want to, I can go to the next slide. They either don't want to give up their low interest rate, or they can't afford to give up their rate. So if you take a look at this, on the orange part at the very top of your chart there are the percentage of the mortgages that are at 3% or less. It's around 20% or so. It's amazing. At the bottom of the chart in the green is the people are paying for 6% for their mortgage or more. And you can see that's steadily increasing over time. So this lock-in effect of these, I feel like I'm handcuffed to my property, I can't give up my mortgage. That effect is becoming smaller and smaller as time goes on. The main challenge I hear from real estate brokers is that people, if they can afford X dollars per month and their current mortgage payment is about that, they would like to trade up or get into a better school district or be closer to their grandmother who needs like assistance. And that new house is going to be 20 or 30% more expensive than the house they have currently. And they'd be going from like a 3% mortgage to a 5.8% mortgage. And that payment is going to ratchet up quite a bit, and they just can't afford to do it. That's what's leading to the amount of home turnover to be a lot less than we would normally expect. So if you need to sell, try to postpone until the negative sentiment boils off. If you're trying to buy, pounce on this opportunity, because it's an incredible time to be a buyer right now. All right, let's go to the next one. So the number of home sales, there's really 3 different eras that we can think about that have taken place over the last 6 or 7 years. So this is the number of home sales by month for different years. So if you take a look at the very top, that's 2020 and 2021. If you remember, the mortgage rates were in the 3 to 4% range during those 2 years, and people were on fire to buy houses. They bought lots and lots of them. So you can see the sales volumes were extremely high. In the middle, you can see just before COVID, I gave you 2015 and 2019. 2016, 2017, 2018 look exactly the same as 2015 and 2019. They're all like in a very tight band. That's the pre-COVID historical average of the number of home sales that you would expect relative to the population of the country. And then the 2 on the bottom are 23 and 24. So after the mortgage rates went from 3% up to 6 or 7 for a period of time. And you can also see the brown line tracking along there, which is 2025. And you can see just how much the home sales have been diminished. It's about 1.5 million less home sales than we'd historically expect. So the sellers are pretty motivated because there aren't enough buyers. That slide really explains so much about what's going on in the market. That does a great job. So when you take a look at home prices, you can take a look at the bottom of this chart, 17, 18, and 19 before COVID, that the average prices were like in the 280 to 300,000 range for the whole US. Prices skyrocketed in 20 and 20 and 2021. If you take a look at 23, 22, 24, the prices have not really changed much at all over the last 3 years. Prices have been very compressed on the price changes. I don't anticipate you're going to see any material price changes for the next at least year to probably year and a half. Don't feel like you're going to miss out on anything price-wise. I also don't think prices will drop a lot. I think they're going to be relatively stable for most parts of the U.S. I should probably pause and ask if you have any questions. I'm going through these kind of fast. No questions? Okay, great. We'll go to the next slide. Yeah. So part of the issue with the buyer pool being compressed is the higher rates. Part of it is a lack of consumer confidence, and that reflected in these 2 lines. So the percentage of deals getting sold to investors is gradually increasing over time, but you can see lately it's been going down. And what I didn't illustrate on this chart, but would be even more dramatic, is the amount of first-time buyers has really been like crushed. It's like half of what it should be. And that's due to the affordability challenges that we talked about 6 or 7 slides back. So once we start getting those people back, we'll have a more robust market. It'll be a more balanced market between the buyers and sellers, which it isn't right now. So people are having to do more price reductions. So if you're trying to sell a house, you may find that you might need to do multiple price reductions over the lifetime of that listing in order to attract a buyer. And that would not have probably been true in 2020 or 2021. So the market has definitely changed in the number of reductions in prices that we're seeing out there. All right. So downturns, I want to talk to you a little bit about this downturn that we're currently in and what you might expect if we learn from history. So if we go to the next chart, this will show you the average home price. I picked Denver as a market. In 1963, the average home price was about $24,000. Currently, I guess this is the average for the overall U.S. I apologize. This is not Denver. This is the whole U.S. And currently, we're a little bit over $400,000. We had sort of a level. The 1980s, when the rates were really high, 2008, when we had a huge foreclosure boom, the first part of 2020, the first quarter, remember like April of 2020 was like massive panic. We were all like quarantined in our houses. You couldn't show a house. You couldn't leave your house. And then this most current slowdown. So let's go to the next slide. Let's look at some of the attributes of these different things and what we can learn from history here. So I want to focus on the column that says home sales drop. That's the one that's highlighted in red. So in the early 80s, we had very high inflation, very high unemployment. So the Federal Reserve, to try to tame that, drove the interest rate very high. And for a period of time, the mortgage rates were in the 15 to 18% range, about what most of you are probably paying for your credit card interest rate. They were paying for a mortgage rate. It's very tough to sell a house with an 18% mortgage rate. So from the peak number of sales that we had just before 1985 to 1985, the sales volume dropped by 50%. It was a very significant drop. It took 4 years for the market to get back to where we were selling a historically normal number of homes. During 2008, you can remember between 2000 and 2007, we had very loose policies. We had what we called were liar loans, where I would state my income, state my assets. The lender would give me, yeah, you're approved for $1 million. Go buy a big house. Do you see my tax return? See my pay stub? Nope, we trust you. It's all okay. And of course, a lot of people bought houses they shouldn't have, and they all gave them back to the bank. And we had a huge number of foreclosures, and the number of sales dropped by 51%. That took about 3 years for us to dig out of that hole. During COVID, you'll remember that we just weren't allowed to sell houses for a period or show houses, and that just killed the market for a period of time. And then the Federal Reserve flooded the market with cash, slashed the interest rate. So rates went from 6.5 down to 3 in a very short period of time. And once you started handing out free money for mortgages, people went out, let's go spend it. It was great. So that was a very quick bounce. It's like 8 months. This time around, the problem is that we've gone from the 3% interest rates back up to historically normal 6 or 7, and everyone's hit the brakes for all the reasons that we just described. We're about 3 years into the slowdown. It's going to be about 4 years before we actually see it start to turn around. And before we get back to normal volume, I think it's going to be 5 or 6. This is going to be a longer, dragged out recovery than the last 3. But the good news is that we're more than halfway through it. It's not the end of the world. It's not going to drop any further than it has. I think that we are at bottom dead center. We're climbing out. I can't prove it, but you guys can laugh at me in 6 months if I'm wrong. But I love history. You can learn so much from it. Will prices drop? So for the quick answer is probably not. Let's go to the next slide. So we are seeing more price cuts because of the slow market. So the average price cut needs to get bigger and bigger the more days your house is on the market. So that's just some rules of thumb of what we see from the National Association of Realtors across the whole US. Next slide, let's talk about why there won't be widespread panic and widespread reductions. Let's skip that one. We'll go to the next one. Part of the problem for affordability is not just the fact that the interest rates have gone up a lot. The insurance and taxes nationally have also gone up 45% just in the last 6 years. Most of that is on the back of insurance rates have really gone up tremendously. And I don't know if that's due to the hurricane damage or the wildfires, mudslides, the plagues of locusts. It's been like one problem after another. But I don't think that's going to reverse anytime soon. It's not going to do any favors for first-time buyers getting into a house. But let's go to the next. National Association of Realtors thinks that we're going to see about a 1.7 increase in home prices next year. I think that's probably just about right for the entire U.S. The next slide. We are going to have a recession sometime, probably in the next 3 years. I don't think it's going to be in 26 based on all the reports I'm reading from the economists in the Wall Street Journal. It wouldn't surprise me if it was in 27 or 28. So a question I get asked a lot is, would you expect that home prices would decline during a recession? And if you look on the left-hand side of the chart, you'll see, historically speaking, that is not the case. So in 80 and 81, we had a very severe recession and home prices still went up. 91 was a time of relatively high rates and a recession. Prices went down a little. 2001, during that recession, you'll remember that the internet boom caused a tech bubble, the dot-com bubble in NASDAQ between about, say, probably like 94 through 2000. NASDAQ at least tripled, if not quadrupled. And I remember this headline at Fortune magazine saying it's different this time. And 3 months later, NASDAQ dropped like 80%. It was amazing. So on the heels of that, in 2001, home prices still went up, even though we were in a national economy due to that dot-com crash. The big exception for the recession is 2008. And that's because of the liar loans that I told you about. We had all these foreclosures. Nobody had any equity. So there was a huge price correction. And we will not see anything at all like that in our next recession. 2020, we had a very brief recession. Prices went up, mostly on the backs of the mortgage rates being so low. What happens to mortgage rates during a recession is they always have gone down historically. I think that we're seeing some of the price reductions now in the mortgage rates that you would historically have seen in a recession. So if we get, say, a few more Fed cuts next year, a little bit more relief in the mortgage rates in 26, pretend that we have a recession in 27, could the mortgage rates go down further? Maybe a point, 0.5, but nothing like what you saw here, like 0.5, or I'm sorry, 5% or 4%, nothing dramatic like that. Now I'll pause for a second. Any questions on that? All right. Go ahead. All right. Will there be a foreclosure boom? I was getting ahead of myself there. We'll go to this next slide and we'll talk about why there won't be a foreclosure boom. So very few homes nationally are in the foreclosure process right now. It's 0.1%. So about 1 out of every 600 homes is in the foreclosure process. There is some variation from one neighborhood to the next. So if you take a look at Nevada, Illinois, and Florida, those are your leaders with the most foreclosure activity. So it's maybe 1 out of 500. If you look at South Dakota, it's probably the champion. They're 1 out of 1,000. There's just not a lot of homes in the foreclosure process right now. The next slide will explain why that is. The negative equity is mostly non-existent. The negative equity is where the value of the house is not enough to cover the mortgage if you sell it. So you'd have to bring cash to the closing. And anybody who's going into a foreclosure is not going to have any cash they could bring to a closing. They've already exhausted all that before they get into that process. So the negative equity is in Austin, and I think that's San Antonio, and then the western seaboard of the Florida markets, and pretty much everyone else is doing pretty well. Next slide. So if you take a look at the mortgage delinquency rate, so our first chart we looked at is foreclosure. So that means that the bank has taken the property back and now the bank's got to sell the house. This is the leading indicator to the mortgages. I'm looking for people who are severely delinquent, 120 or at least 90 days late on their mortgage payment. You're seriously in the hole when that happens. And you can see that we're floating at about 3.2%. And if you look at the gray line, that's the long-term historical average. So the delinquency rate's quite a bit less than historical. So that's a good leading indicator that the foreclosure rate will probably stay low for a while. Okay, what's going to happen to mortgage rates? I think briefly, if you go ahead a slide, they're going to go down a slight bit more, but we've seen a tremendous amount of progress from the beginning of the year where we were in the low 7s and now we're in the high 5s. Been a very good year for the mortgage payments. I've been so excited to see this happen. This is why I think we're past the bottom and we're going to start climbing our way out. This is going to stimulate the market. Okay, next. All the housing economists always say that mortgage rates are going to go down. I can't remember a time I've ever seen in the last decade where they thought rates were going to go up. So these guys aren't very accurate with their crystal ball, but there's their forecast. They think rates are going to decline a little bit more. They're probably right. Okay, currently that's chart's a little bit out of date. It goes out of date like in 3 hours after update. We're right about 6.05 right now. So while the rate feels relatively high, relative to the delicious 3% loans that we had in 2021, historically speaking, the 50-year average is just under 8%. These aren't bad rates. There's nothing wrong with these rates that we have today. Okay, we'll kick ahead a slide. I'm actually going to get through all these in 30 minutes. I can't believe it. So do these increasing rates impact our market? And the answer is, well, of course they do. So sales are going to be a little bit soft next year. We talked about that, but the sales volume will probably increase a little bit. I think we talked about that because we're past the worst of the rates. And it's going to be a little bit easier next year to sell. The next slide. So showing traffic, this is the number of showings per active listing per month. And that's a pretty good barometer for like how busy are the buyers out in the market. So you can see in 2020 and 2021, that's the top in the green. We had a lot of showing traffic because there wasn't very many listings. There was lots of buyers with these 3% mortgage approvals that they were just dying to spend the money. Lots and lots of showing traffic. If you take a look at the blue line that's dashed in the middle, that's the average pre-COVID. So that's the average of 17, 18, and 19. And then you can see ever since then, 22, 23, 24, and so far for 25, we've had a little bit less showing traffic every year. I think this year is bottom dead center. I think you're going to see the showing traffic next year will be a little bit better. There'll be more buyers out there looking to buy. Next slide. So let's do a couple slides on apartments. That's mostly what I get to think about every day is which apartment building to buy. So this shows you like almost 20 years worth of data on the average prices for different facets of commercial real estate. And you can see that in the 2007 to 2010 correction, the average apartment price dropped about 30%. And actually almost all the commercial asset classes, office, retail, industrial, all corrected by just about the same amount. And they all corrected in a very synchronized sort of a fashion. This downturn has really been a lot different. The apartments have corrected about 20%. You can see we've got several quarters now where it's been relatively flat. I will call it that we're past the bottom and you're going to start seeing the prices go up at a slow pace and then at a better pace in about 18 months. Interestingly, if you look at the green line, industrial has been the shining star of this correction. Like they've gone up in price a pretty healthy amount while everybody else has suffered. And you probably won't be surprised to discover that office has taken it on the chin more than anybody else. The office line that you see there in the turquoise, that's CBD, central business district. So the downtown office market has suffered a lot more. The suburban office market, so that's the light blue line, not nearly as much of a correction. That's been a much more stable asset. And finally, retail has just been flat and steady all the way through that. And I think you're going to see retail continue to go up a little bit. I think you probably are at the bottom for office pricing at this point. It's been such a huge correction. Interesting times. So why am I optimistic about the multifamily market? Absorption is the big driver of this. Absorption is just a fancy word saying that we had a unit that was vacant and we got a tenant in that unit during this time period. So we've absorbed one unit of vacancy and now it's occupied. And you can see that our absorption over the last several quarters is at all-time highs, best absorption numbers we've ever seen in history. Why is that? Because first-time buyers can't afford to buy houses. That's entirely the driver of all this. So will that continue for a while? Yes, it'll at least continue until we get a recession, and then you'll see things relax a bit. So if we go to the next slide, we can see that's the demand side. On the supply side, you can see that we've also delivered a lot of units. It's not a record number. You'd have to go back about 15 years and you'd see some higher numbers. But in the more recent history, like the last 5 years or so, been a lot of deliveries. Why is that? So if you think about the apartment building that got delivered in like the spring of this year of 25, that was initially an idea of a developer sometime in early 2020. They put together the business case and bought the land sometime in 21, and the interest rates were effectively 0%. And the banks had all this cash from the Federal Reserve, so they had to make a bunch of loans because nobody makes money with the bank sitting in the vault, with the money sitting in the vault of the bank. So if you went to a lender in 21 saying, I want to build an apartment building, if you had a halfway of a business plan, they said yes. And then it takes about 3.5, 4 years to build it and lease it up. So you could see the number of deliveries hit this huge peak 3 to 4 years after that ultra cheap money when the banks were in a very lending sort of a mood. And we can forecast the number of deliveries with a high degree of accuracy over the next 36 months, because if it isn't under construction right now, it's going to be at least 3 years before that comes out of the ground and is ready for someone to move into. So we've got a decreasing amount of supply being added to the market. We've got a very aggressive amount of demand absorbing units. So even though we've delivered a ton of new units, we've been filling them just about as fast as we finish these buildings off. Not quite, just about. So if you go to the next slide, you're going to see that rents have been a little soft. Oh, it's just saying that if you want to raise money to build an office or an apartment building now, good luck with that. Investors aren't too excited about providing the equity. Banks are not at all excited about making a loan. So it's like a non-starter. So the amount of supply 3 or 4 years from now is going to be very low, just because nobody can get a project approved right now. Next, we don't have a lot of distressed properties. I don't anticipate it's going to get a lot higher than this either. Although everyone thinks that multifamily is going to have this giant correction, the reality is like the correction took place about 2 years ago on pricing. Pricing's dropped about 20%. This is probably the price we're going to be at. Will there be more foreclosures on the office side? Yes, probably particularly in the central business districts, more so than in the suburban area. If you are a sophisticated buyer for office, I think you could probably rifle shot some incredible deals right now, but I think you could wait 6-9 months and maybe even get a slightly better price. But I would start hunting now if office is your thing. We're more interested in multifamily. Historically speaking, multifamily has the lowest returns of all of the different asset classes and the least amount of volatility. Our goal is to deliver singles and doubles with our investors, not swing for the fences. And I want to be able to sleep well at night, and I don't want to worry about it. And if I bought office right now, I'd be still thinking about it 3 a.m. saying, did I do the right thing or not? Next slide. Okay. One additional driver of why I'm really excited about apartments is just simply demographics, because demographics is destiny. So this is the percentage of the 25 to 34-year-olds living with their parents. And I have 3 kids in this age range. I'm very ecstatic. I finally got them all out of the house. It was like a Herculean effort getting them into their own places. We're very close to the high end of the range of the number of these young adults living in the basements of their parents. And both the kids and the parents want them out. If you were to take the high number of young adults living at home and take it down to the historical normal level that should be, it would create almost 1 million new renters. So there's a huge amount of rental demand on the sideline. And once these guys get jobs and they're economically able to move out from their parents' house, I'm sure they're going to do that. In addition, a lot of the headwinds we've got for first-time buyers to be able to buy their first place, we've discussed at length, that's not going to resolve anytime soon. So I think the rental demand side is going to be very strong for quite a while. Next. So rents have been soft. I think they're going to be soft for about the next year. We've got just like that last little bit of all the supply that just got added that's got to get absorbed. And then once, historically, it's like right around 95% occupancy or a 5% vacancy rate. That's when you can start having some aggression with your rent prices. We're a little bit below that right now. So the name of the game is to get occupancy. So I'm not going to try to push rents. I'm just going to try to get the building completely full, and then I'll push the rents. That's going to be another 12, maybe 18 months, and then the rest should start going up. The headwind will be that about the time that we get to that point, we'll probably be in a recession, which means it'll be like another year that'll be a little bit soft, and then it'll really take off after that, most likely. And valuations will follow right behind that, because every time you raise the rent $1, the operating expenses are mostly static. Almost all that dollar drops right to the bottom line. And the rough rule of thumb is it's about a 16 to 20 multiplier on the value of your building. So if you increase the cash flow by $1, the value of your building goes up somewhere between $16 and $20. So it's a very powerful lever for evaluations once we see that inflection point. Let's go to the next slide. That's our forecast where we're going to go. And I think that's about my last slide too. So let's just go to the end and we'll give the little call to action there. So if you guys want, you can go to irontoncapital.com/financial freedom and download a copy of our book on passive investing. We'd love to share that with you. And I'm at 31 minutes. I almost got it.
Yeah, thanks so much for this. It's going to be really interesting because next year, Jerome Powell's gone, and it'll be really interesting, the housing market and the rates and the equities market as well. So thanks so much for doing this. And we look forward to the next quarters and constantly evaluating the trends. And thanks so much for coming on and providing so much value to the audience.
Thank you so much for having me on. It's always